Don't be surprised when this happens. That's what we're going to talk about on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intramarket analysis. If you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated. And subscribe to the channel if you like this type of content. We're going to get right into today's episode. We're going to start off by looking at how the markets performed. We got over here some index products, and over here we have our 11 sectors that make up the S&P 500. Risk off day. As you can see, we had consumer staples, utility lead the way. Even energy were up there. The index products were, relatively flat on the day. Small caps took the biggest hit, but yet those have been up, in recent weeks here pretty strongly. So they're taking a little bit of a backseat. Same with mid caps. S&P 500 down 38 basis points. So not much there. As far as what we got going on for the remainder of the week, we do have FOMC minutes tomorrow. We have Fed Kashkari. We got Fed Bar, all kinds of Fed talk is what we're having. Then Thursday, we have some more Fed talk, and Friday we get some more Fed talk on top of that. I like to start off over here looking really at the S&P 500. And as you can see, we did have a little bit of a down day today, but it still remains well within this bullish channel. Now, this bullish channel, right, you can see the series of higher lows connecting, creating that trend line. The more times we test it, right, there's a possibility that we break down. And then even when you break down, you can potentially go to retest it. But sometimes when you break these significant trends or ranges, you can see volatility increase. And that's both to the upside and or downside. Other than that, what do I see? I see the percent price oscillator pretty much losing a lot of momentum. And we do have a subtle divergence still continuing to build in the RSI. If I take a look at breadth for the S&P 500, what we got here is the S&P 500 beneath us, and then we got the percent of stocks above the 20-day, 50-day, and 200-day. And as you can see, the market has been pricing higher, right? Pretty much new all-time highs for every day. But the percent of stocks above the 20-day, right, they've been going down. The percent of stocks above the 50-day, that has been declining. S&P 500 percent of stocks above the 200-day, subtle decline over here too as well. So what does this tell us? It's just telling us that the market's pricing higher, but it's been doing so with fewer participants overall. So that right there is somewhat of a breadth divergence. And divergences can last for a long time, but they do typically resolve in one of two ways. First way being that the market leaders that have been kind of dragging this market higher and higher, all of a sudden are going to catch down and go through a little bit more of a digestion consolidation. The flip side of this is if all of a sudden we see breadth increase and a lot of the names that have not been above their 220-day, 50-day, and so forth, those all of a sudden catch some momentum and we start to see rotations back into those names, and that can be quite beneficial. If we continue on, if we look at the expected move for the week, you can see we're looking at about $9.58 of expectation. So that's bigger than last week and the week prior. The week prior to that was slightly bigger, but we had no tag of that weekly implied move. Remember, last quarter we had 70% of the weeks, which is, I think we had 14 trading weeks. So 70% of those tagged and or exceeded the weekly implied move. So last week we did tag it. This week we're basically unchanged. Let's be real. We're basically unchanged from a week-to-date perspective as it stands right now. So we still have, Wednesday, Thursday, Friday, and $9 plus or minus expectations of risk. So we have a high probability of hitting one of these expected moves. Does that mean we have to hit it? No, not necessarily. It's typically saying, what it's saying here is we, 68% of the time, right, we close within one standard deviation, this being one standard deviation of risk. But from what I've noticed is, and from statistics of what we've been looking at this year and this last quarter, there's also, a 68 plus percent probability, 70% probability that we actually tag it. So be open to the possibility of still a strong move this week, which we have not seen. Now, if we look at today's price action, you can see what we did, start off higher, and then we just sold off through the day right into where the daily expected move. Go figure, right? These levels are actually important. It's what the market forward looks and prices as risk. So, it's safe to assume that I should probably show you what tomorrow's day looks like. And if you like these levels, I share them all the time here on the Stock Market Brief Show for absolutely free. And if you want your own levels, how I generate these daily implied moves, daily implied zones, weekly, monthly even, I have the Discord where you can go into that, and $16 a month, and I have all types of benefits there. We'll talk about that another day. Here's SPY on the 15-minute time frame, updated daily implied moves. You got 665 down to around 663, 673 to and around 674. Those are the upper daily implied moves. Okay, now there's a couple of things going on here that I want to point out. We are pretty much on the 5-day moving average, and we're below the October the October volume weighted average price. So over here, right, what do we say? When we started ripping up higher, the episode we talked about was look for a pullback to the October VWAP because you typically get your strongest reaction from the first touch. Those words exactly, right? What did we do? We reacted, we went higher, okay? The second test was right over here. We went up, we broke up, we went a little bit higher, right? Not as quite as aggressive as a move like this, but pretty darn similar. Now, the third test, we're breaking through it, and now we're holding under it. So this tells me very, very quickly that this volume weighted average price, it matters. It's more bullish if we can get above it. More importantly, get above the week to date, right? So we're kind of sitting around this area where there's, a ball of overhead supply. But if we start breaking down and the 5-day moving average starts turning and this starts turning down too, and the week to date starts coming in, that can act as a potential level of resistance and a shorter term change in trend, okay? So if we get good news overnight and all of a sudden the market gaps up through this, okay, I'm looking for a tag of the daily implied move. But if we open kind of where we are or slightly lower, I'm significantly more cautious in how I'm going to approach this market. I'll be looking for lower tags of the daily move, maybe even the lower weekly as time progresses. Now, if I look at the direction of the 5-day moving average across SPY, Q, IWM, semiconductors, biotech, and DIA, they were all green. Now they're all yellow. The reason they're yellow is because right now price closed underneath it, but yet the direction of the 5-day moving average is still trending higher, okay? So this is just telling us, hey, be cautionary over here. This is where trends could potentially change, okay? Just like over here, right, for the Qs and for the SPY, right? Price was above it, but this was trending lower. It says, hey, be cautionary. The trend may be changing to the upside, right? That's what it was telling us because price was above it. Now, one thing that's different from this last red period, we went yellow and then transitioned to red, was that the semiconductors actually never fell underneath that 5-day moving average. So that was the difference there, and we discussed it on that episode. But now we actually see semiconductors crossing under it right now. So it's just giving us a little bit of a warning shot. This is a pretty strong move to the downside. I don't know if it's going to get continuation right out of the gate or if we're going to bounce up and then potentially consolidate more. This is going to flatten out over time and then maybe take a little bit of a break or try to come back up, little shakeouts here and there, and then take a little bit of a consolidation break. Be patient and wait for that. But right now, as I'm stating now, we're just seeing a little bit of a cautionary sign between SPY, Qs, and obviously one of the more important sectors being semiconductors. If we take a look at the gamma exposure, we're looking into market conditions now. There's still a call wall at 6,800. Traders are still reaching out further, right, to 7,000. But I wanted to mark out a couple of levels, right? 6,800 will be the call wall. This is where price action could potentially go to and see some pinning action or reject from. Then you got 50 points lower at 6,750 and 6,700. Beneath that, you're looking at about a 50-point slip, okay? So if I was to, display that, on here, today we went into 6,750. We found resistance, and then 6,700 was also a level that we marked out, in the early morning in the Discord channel. That was a focus, a concentrated area from a 0-date perspective. And as price was slipping into this area, this made for a good little opportunity back into the daily implied move. I traded that today, right? If you were short and you shorted, you were short for the day, you would have been looking at the daily implied move and or these lower levels to potentially cover some would be ideal, right? You don't want to start a new short position as price went directly into a key gamma exposure level. So that's what the daily implied moves look like for the S&P 500, for the SPX. Tomorrow, if you're looking for the daily SPX levels, we got 6678 below us, 6752, and we are still above the gamma flip line, which is roughly at about 60, I'm just going to say 6650. Remember, it's a zone, right? It's a zone, so it's slightly above the lower weekly implied move. But if we can get down here, this is where you can see volatility increase, right? Dealers can sell into the selling, buy into the buying, but still a little bit of a distance away. Now, if I apply these bands to the S&P 500 and lay out some of these levels, this is, goes to the title that, hey, don't be shocked if this happens. Many times when you apply these bands, right, these are known as BridgeBands. I like them. They're a great, I extract these BridgeBands in like a bulk document, and I created a zones document, and then it gives you a really quick snapshot fractal view of the market. So you don't need to just look at one asset at a time. You can look at everything all together from a global perspective, dollar, volatility, everything. And I do that updated daily in the Discord as well. I've shared it on prior videos. But what I wanted to call out here is really don't be shocked if we come down to the lower range of it, right? The lower range of this is at 6,600. I'm just going to round it, 6,600. And we've came down to it, right? When you get to the top of the range, there's times where you go to the bottom, right? When you go to the bottom of the range, there's times that you go right back to the top. And we're not too far off the top, which is roughly at 6776. So almost about 6,800. As you can see, I drew some of these lines, and those are those gamma exposure levels. We have that 6,800, 6,750, and 6,700. And really, if you start getting under that 6,700, you can have that, what we were talking about, that potential 50-point slip up as the liquidity kind of just, evaporates here. So I would just be aware of that. And if we do see that, don't be shocked if it happens, but I'd be preparing to execute in these lower ranges over here, because it doesn't necessarily mean that this is this is it, right? The market's crashing, right? This is only about, 1.5% drop, which can happen very quickly. I don't know if it's going to happen tomorrow or the next day, but don't be shocked when we come down and eventually test the lower range. Now, as far as trend goes, that's still, roughly at around 6,500. And as you can see, these bands, we've been putting in a series of higher lows and higher highs here. So nothing there has changed dramatically. If we start seeing, lower highs form in the bands, that's when you can actually go through more periods of consolidation, which we just have not seen yet at this current moment. This yellow line over here at 6650, right? That's that gamma flip line. That's why I highlighted it yellow, but that also happens to be a gamma exposure level. So this, right, these levels I'll be paying very close attention to from an intraday perspective moving forward. Now, if we take a look at some of the other systematics, right, I've been pulling these from Tier 1 Alpha. I also have Gamma Lab that I can pull these from. I just like how Tier 1 displays it dating back further than what I can get from Gamma Lab. And as you can see, their model over here, right, this CTAs have been the highest they've been since 2020. We've been talking about this, right? If we continue on vol control funds, it's the same thing. Pretty frothy levels, frothy readings. So in order for these guys to become sellers, vol control funds, risk parity, CTAs, you name it, you want to see price action of the S&P 500 start to slip potentially under that gamma flip line, which we're still clearly above as it stands right now. If we continue on and we look at housing, I thought this was just an interesting chart today. It was down 2.99%. So housing index, which is rate sensitive, got just smacked. And I don't know if this is an ominous sign yet, but what I will say is that it has been a good leading indicator of the S&P 500. Now, these divergences, they can build for long periods of time. Like, for example, if you go back to the financial crisis and you look at, wait, what was the housing market doing then? The housing market topped in 2005. It never saw a high after that point since after, from the financial crisis. So the S&P 500 kept on going higher and higher, and then yet the housing index never reached its 2005 high. Now, from a shorter perspective, you can see like multiple months, right? We went matching highs, but the S&P 500 went higher. What happened? We went to, a sell-off. Over here, you actually saw a higher low being built in a housing market, while the S&P 500 put in a lower low. And that could have been an indication for saying, hey, you know what? Housing looks like there's strength coming into the sector. Are we going to see sudden shifts? And well, we did. Even over here, more recently, going into February of really this year, this sell-off, the S&P 500 kept pressing higher into February, but the housing market actually topped in October of the prior year, okay? Now, what are we seeing? Well, we see this high, and we see, this high and a higher high over here with the housing market, but even back further, we still haven't met a new high yet for the housing index, and that's kind of an ominous sign. So, it'd be much better if we can see housing start to perform and start to break to new highs, but we just have not seen that yet. And this is one of those sector divergences that has mattered in the past. I couldn't tell you if it's going to matter this time, but it has been mattering. And the same thing goes for things like the transports and the Dow. The transports, if you look at that index, that has been underperforming the Dow Jones Industrial Average by a wide margin. Okay, I want to continue on and look at just some of the dollar correlations because I haven't talked to it for a bit, but we've been prepping for a bounce in the dollar. And well, the dollar has been bouncing here, right? Just like it did in that 2017 analog that we rode where September found its low and then we started moving higher and then it started selling off into the next year. But it's important to note, what are the correlations telling us right now? And that's why I wanted to bring up the dollar correlations because surprisingly enough, they're not actually giving us much data. So the amount of weight that you can put on a higher move in the dollar extends out to a longer period of time, but the shorter time frame is a little bit different. So for example, take a look at the 15-day, 30-day, 90-day, 120, and 180 trading day correlation of the dollar to the S&P 500. Right here, yeah, there's actually a positive correlation, meaning dollar goes up, S&P 500 can go up, right? But it's like the correlation is at 0.25, so it's like basically nothing, right? Over here on the 30-day, it's slightly negative. like by 0.19, basically nothing. Now, if you go out further and you look at the, 90 to 180 day, those are negative and they're a little bit deeper. So the longer term right now, the dollar still has that negative correlation, but the shorter time frame, we're seeing subtle shifts. Now, if we look at gold, right, gold typically has a negative correlation to the dollar, but look at the shorter term, it's actually positively correlated. So the dollar was up today, gold was up today, right? Why? Because they're actually positively correlated right now. If you go to 30 days, basically nothing. But if you go out deeper, 90 to 180 days, still a pretty strong negative correlation the further you go out. So overall, like through time, if the dollar was to bounce for a month and more, you're probably going to see gold consolidate. Now, if I just pull up a chart of gold so you can see it a little bit cleaner, we did reach into that 4,000. I believe we reached into 4,000, at least gold futures, but the spot gold from CME over here, apparently not. But we're basically there. Okay, continue on. The next dollar correlation I want to look at was oil. And you can see from a very short time frame, 15 days, a few trading weeks, there is no correlation. Okay, 30 days, like no correlation. So we got 15, 30, 90 day, it's a little bit of a positive correlation, and even the 180 days positively correlated. So right now, from the shorter term perspective, there's really no correlation between dollar and oil. Okay, but if we do look at oil, it saw a little bit of a bounce today. Overall, it still remains in a bearish trend. The one that we do want to watch is what the 10-year yield does if oil continues to go higher, because oil can typically be a leading indicator for yield. So if this actually goes up, it could be bad for bonds. Now, if oil continues to break down, that could actually be a positive sign for bonds. And if you look at like something like the TLT, which I don't have a chart of, it's actually been kind of consolidating, right? We saw a nice move up and it's been just chopping around, flagging around. So it could be one just to continue to watch, just in case if oil was going to continue this trend currently to the downside. That's all I got for you on today's episode, everybody. If you want to join that Patreon or Discord, there are a bunch of different benefits, some that I don't even list here. There's a pinned link in the description and in the comment where you can click and you can go look at it. I got all kinds of stuff in there. I'll talk about it more another day. See you later.